Welcome to the Q2 2026 earnings call for Dolla Financial Limited. Dolla has done yet another amazing quarter, and they have put out those financial results for you, their shareholders, to see and examine. And now they're here to talk about those results and to answer your questions. So please join me in welcoming Mr. Ken Royker, CEO of Dolla Financial Services. And later on, joining us will be Trevine McKenzie, the group chief financial officer. So welcome, Kenroy, once again.
Hi, Renee. Good evening. Good evening to your viewers. It's always a pleasure to be on this platform to share updates. Good or bad, I always say we are always available and willing to um, give the information and answer any questions your viewers may have.
Absolutely. And we're always happy to have you. We appreciate the transparency and the willingness to be here and share whether things are looking good or not, right? It is important, it's an important part of the conversation with shareholders and the companies that they're holding those shares in. So thank
Certainly.
you for your commitment to that. Thank you for being here. So as is customary, let us open with a word of prayer and then I will hand over to you, Kenroy, for your call. Heavenly Father, we thank you so much for this day. We thank you for this company, oh God, and we thank you for this team that continues to be committed to their shareholders, Lord. We thank you for the opportunities that are being made available to the investing public, Lord God. We through Dollar Financial, we thank you that they continue to do their best to perform well and to elevate everyone around them. We thank you and we pray your blessing over them in Jesus' name. Amen.
Amen.
All right, so over to you, Kenroy.
All right. Thanks again. Thanks again, Renee, and good evening once again to your listeners. Thanks for joining us for Q2 2026 earnings call. We are pleased to provide an update on our financial performance, our strategic progress, and the priorities that we have for the remainder of 2026. Today, as Renee said, I'm joined by Trevine McKenzie, our Chief Financial Officer, who will give us some further insight into the numbers for Q2 and what are obviously driving those numbers. So, the first half of 2026 was an important period for the group. We delivered strong growth in the loan portfolio. We strengthened our liquidity and completed the acquisition of the Evolve loan portfolio. And that obviously is the most significant acquisition in Dollar's history. So that is something that we are really proud of for the first half of 2026. Now on the screen, you'll just see an overview, just to run through an overview of what things are looking like for the first half of the year. Our net loan portfolio closed in June at 5.3 billion, representing growth of approximately $670 million or a 15% year over year increase. And this is also a 6% rise when compared to December 2025. The growth was really entirely attributable to organic. It was organic growth, and it really reflects the continued demand that we're seeing for the services that we offer. In terms of revenues for Q2, we closed the quarter at $536 million in revenue, which is 5% ahead of the corresponding period or the corresponding period for 2025. While we closed the year at $1 billion in revenue, actually $1,015 million, and that was an increase of 4% year over year. Profit before tax was at 194 million for Q2, and that's up 47% year over year. And we are looking at $382 million for the 6 month period, and this is up 52% when compared to the same period for 2025. Net profit increased. We're seeing that rising to $169 million for Q2, and we're also looking at a $357 million in profit year to date in terms of net profit. All right, and the improvement in profitability obviously would have been driven by the growth in the loan portfolio and materially lower credit cost or credit provision, and the fact that we have remained very disciplined in terms of the management of our expenses. In terms of ECL and NPL, our credit quality improved during the quarter, with non-performing loan ratio moving from 15% as at the end of Q1 to 14% in June. And this is because obviously we have made it a focus to pursue collections, and we continue to have that as a strategy. We have seen where we are realizing some gains from the liquidation of collateral that are impacting loans in a non-performing state, and obviously getting one or two loans that are we consider legacy arrears, where we're seeing just a slight uptick in collections for those. The Q2 ECL charge was 34 million, and it's kind of consistent with what we would have seen in Q1. So for the year to date, or the first half of the year, we're looking at about $70 million in terms of ECL, this being at 4.9%, which is still flat quarter over quarter. And one of the points to note regarding the ECL is that all new loans that were disbursed during the period were actually secured facility. These carry a lower ECL, and as such, you would have seen where the loan portfolio would have risen by 15%, but the ECL remained relatively stable. And this is because of the fact that we continue to pursue the secured loan strategy, with the bulk of the transactions being secured by real estate or motor vehicles. In terms of the portfolio now and the sector performance, we continue to see strong growth in terms of the business lending, and that remains the core of the portfolio. That accounted for 94% of the total loans on our book as at June, while secured loans, just spoke about just in the previous comment, is at 91%. And again, this is really a strategy that we have maintained to ensure that we lower the risk of default, as well as the recovery being easier, and having a lower impact on the ECL, or the provision that we have to make on each loan. Sorry. Now, transportation and logistics, you're seeing this chart, and you can see that it accounts for the bulk of the loan in terms of the sector that we have been focusing on. And this has been deliberate. I've said it before on the previous earning call, that this is a sector that we see it remains viable, and there's a lot of growth prospect. I mean, when you look at the transportation industry, a lot of it being made up of truckers, taxi drivers. This is an industry that really remains resilient. Even I mean, it's a sector that really remains resilient, and it's one that's also consistent and in line with the strict secured loan strategy that we do have, and is a key part of the KPIs that we track. Our operational efficiency, I think it's probably on the page prior, but our operational efficiency is at 42% for the 6-month period, and this is compared to a 56% in the corresponding period. And again, this really reflects the benefit of the small growth that we see in revenue, and of course the fact that we have been very disciplined in terms of the management of our expenses, admin expenses, and all other expenses have really remained broadly flat year over year. In On the final slide, I believe I've spoken about this one already. So this would be again the business. Just noting that the bulk of the loans that are on our portfolio, the majority being 94% of the loans are secured, are actually loans to entrepreneurs and small businesses, and the 91% of these facilities are adequately secured by real estate, motor vehicles, and in some cases we have shares, stocks. Some customers even have their dollar stocks that they have used as collateral to take loans. So if you have a dollar stock, if you have any other stock that's doing well, listed on the Jamaica Stock Exchange, you can always approach us, and instead of liquidating your stocks, we will be a buffer for you in terms of a loan at dollar. So just bear that in mind. All right, so I'm just going to pause here and introduce Trevine, who will just take us through the numbers for Q2 and what's really been driving those numbers.
All right, thanks, Kenroy, and good evening, everyone. I just want to say thank you very much for taking the time out of your evening to converse with us regarding the Q2 2026 financials. So let's just jump into it. Now, a lot of these metrics Kenroy would have mentioned previously, and he would have given you great explanations for what took place. But the big picture for us in terms of the financial highlights, firstly, is the growth in profit before tax, which stood at $382 million as at the end of the period. And this increased by 52% year over year. Notable to call out as well would be our increase in shareholders' equity, which went up by 35% up to $1.8 billion, and our earnings per share that increased to 14 cents per share, up 40% from the 10 cents per share that we would have reported in the comparative period. Now, we also have some metrics that did not move in the way that we probably would have been hoping, but they're still positive movements. So, total revenue would have essentially been flat. We look at our loan portfolio that stood at $5 billion as at the end of the period, which increased by 15%. Still some growth there, even though we were hoping for more growth, but we will speak about that later on. And we would have seen where debt increased to $3.7 billion, of course, due to the bond that we would have closed in January, and our net interest income would have reduced by 3% as we would have been recognizing or capitalizing that interest expense on the bond. And we will talk about that a little bit later. Now let's jump into the balance sheet and dive into what took place over the past 6 months. Starting with cash and cash equivalents, we are noticing a very big jump from June 2025 of $47 million up to $593 million. And I realize that this has been a really strong topic of discussion. Now, of course, we would have seen where we have some funds remaining from the bond raise that closed in January of 2026. And we're looking at about $600 million in terms of cash. Now, just to break this down a little bit, yes, there is cash, but we would have repaid interest expense as at the end of the period, which is to the tune of about $100 million. And of course, you would have seen where we would have also paid out our second dividend payment for the year of $92 million. So net, we're looking at just about $400 to $350 million in terms of cash and cash equivalents sitting at this point in time. We do have some restricted cash as well, just to the tune of about $50 million. So we're looking at maybe about $200 million in terms of discretionary cash. Now, you may have seen on Instagram or on social media whereby we are pushing our summer promotion that has really increased sales over the summer. So we're seeing where some of this cash has now been deployed into those loans. And because of this uptick, we're expecting it to continue out or down into the following 2 months. So we will see this cash being deployed in very short order come the next 2 months. Now, we spoke about the loan portfolio. We're seeing a 15% increase year over year. We have recovered somewhat from Melissa. Remember, Melissa would have taken place in October, and some of our major branches would have been hit. That would have been Savlamar and Junction, and some of our most active loan officers, for example, Yannick and Savlamar, would not have been able to do the sales that she would have normally done and meet 100% of her target that she would normally do. But since we are seeing where the economy is recovering and these communities are recovering, we're seeing where there is an uptick in sales due to that as well. And we're now seeing where the loan portfolio is starting to grow at a faster rate than it did in the last 6 months. So we're expecting that in Q3 and Q4, we should see more growth in the loan portfolio, up and above the 15% that we are seeing here for the first half of the year. Now, moving on to loans payable, we're moving from $3.2 billion up to $3.7 billion, and this is solely due to the bond that we would have closed in January, net of the bond that we would have repaid in October or December of 2025. And all in all, we're seeing where the impact of the earnings for the period would have increased our shareholders' equity from $1.3 billion up to $1.8 billion, which is a 35% increase year over year. Now, when we take a look at our profit before loss or our comprehensive income statement, we are very pleased to say that we have a profit before tax that increased by 52%. Now, we're seeing where this is solely due to the reduction in operating expenses for the period. And when we look at what we would have faced in June of 2025, whereby we would have written off just about $100 million in terms of loans, we have those eventualities have not taken place in June of 2026. Hence, we have a significant reduction in our provision for expected credit losses for the period, which would have reduced our overall operating expense for the business. And because we're very mindful of everything that's happening in the economy, and because of all the issues financial services and those companies are facing, we have been very prudent in terms of managing operating expense outside of our non-performing loans and our expected credit losses. So we have ensured that those have remained flat, and with the reduction in the ECL, we're seeing where it has positively impacted the bottom line. Now, if we move a little bit further up and we look at our total income, we're seeing where this has been relatively flat. And of course, this is due to the last 6 months whereby we were not lending at the same pace that we normally would have been in the first half of the year. Of course, because some of our branches were very heavily impacted by the hurricane, and the lending activity in those areas were not the same. But we're seeing where that has recovered significantly, and we're seeing where we're starting to see an uptick in income, and we should see where these metrics will be increasing in the second half of the year. And of course, we discussed cash heavily on the balance sheet page, whereby we have a significant movement in terms of how much cash we are sitting on now. And I did break down where we are in terms of cash in actuality versus where we stood at as at the end of June. We would have seen where net cash from operations would have increased because the business has been generating cash. We have been collecting, and we're seeing a lot of activity there. In terms of investing activities, we would have seen some movements there, some smaller movements in terms of purchasing of assets, etc., which would have led to this increase, which is a significant increase over where we would have seen it in June 2025, but in dollar value, not so much. And of course, in terms of cash used in financing activities, we're seeing a major movement, and this is due to the payments that we would have made for our interest expenses throughout the period. So all in all, when we look at cash, we aren't seeing any major outliers. We are just seeing where there is more cash than we normally have, and we would have gone through the reasoning for that and our plans for the next 2 quarters in terms of the deployment of cash to capitalize it as interest income. So at this time, I will hand back to our CEO, Kenroy Carr, to just take you through our outlook and answer your questions.
Oh, Kenroy, we're not hearing you.
Thank you, Trevine. Thanks, Renee. So just to give an update on the Evolve loan portfolio. So the transaction was completed in the transaction would have been executed as at the 30th of June. It provides Dollar with an established portfolio, and just to make it clear that this is an acquisition of Evolve's loan portfolio and not the company. So it's just a loan portfolio. It's approximately $700 million in terms of a gross loan, and that's gross. Obviously, it will be adjusted for expected credit losses and NPL and all of those other variables. And it also brings with it approximately 1,500 new customer relationships. So it allows us to really expand our customer base without having to solely be doing this organically. And it's important to note that the the main thing that we're looking at from this portfolio, and while we work on completing the full transition during the second half of the financial year, is how we leverage the data that we have acquired with this portfolio and how we can continue to grow the business based on this new customer base that we have access to. So right now we're pretty much looking at completing the entire transition process. We have done significant work since June, well, since the beginning of the year, but especially since the closing of the transaction, in terms of transfer of file, reconciling accounting, and all those other transactions. And we do anticipate that maybe perhaps by the end of this month, we should have closed out all of our the main transition, the main things that we need to transition from Evolve to Dollar. And you should be seeing those numbers reflecting in, you should be seeing the portfolio being adjusted to reflect the Evolve acquisition once we publish our Q3 numbers. And in terms of the rest of the year, obviously, we will continue to focus on deploying the available liquidity into quality, secured, and in particular, the continued focus of business loans. So, as Traveen says, one of the things that I guess one of the questions that our shareholders may have now is the portfolio, the income didn't grow, but we still have a lot of cash. Is it a case where we cannot deploy, or we don't have enough demand? But it's really not us trying to just deploy funds as quickly as we can. It's really a strategic approach to ensure that, one, when we do deploy the funds, these are quality. These are the highest quality. The loans are secured, and in fact, they still form a part of the strategy that we have to grow the portfolio and ensure that it's quality growth. So we would have launched our campaign in July for Q3, and the uptick has been significant in terms of disbursement for the month of July so far, and we're also seeing that momentum carrying over into August. And obviously, I'm quite positive that we will see that reflected in the income for Q3. I mentioned the Evolve portfolio already, that this will be also a core focus for us to just complete the operational integration of that portfolio which we have acquired, and just to ensure that we maximize the value that we get from, especially the clients that we have acquired from Evolve. Um, Credit quality and collections continue to be a key focus for us. So reducing our non-performing exposure through stronger collections. We have made several adjustments to the collection strategy for the group, and just tracking those to ensure that we're actually seeing improved results on a daily and a weekly and a monthly basis, right? And obviously, the operational efficiency will continue to be a major um, thing that we'll continue to focus on for 2026. Of course, maintaining disciplined operational expenses, while just strengthening the systems that we have in place, strengthening the controls, and ensuring that customer experience across the group is top notch, and that we can not just maintain but continue to build our customer base and improve their lives. And I believe that once that continues to be the focus continues to be on the customer, then we will see it in the profitability. You will see it in the stock price. You will see it in the dividends, and everybody wins. Everybody will be happy where that is concerned. So that continues to be the focus. 2026, the first half of 2026, we saw significant growth in a lot of our key indices that we do track, and we do anticipate that the second half of 2026 will even be better than the first half.
All right. Thank you so much, Kenroy, for that. And that brings us right into our Q&A. So we have a few questions in the chat from Michael, who has been pretty active. So thank you. Thank you, Michael, for being here and for asking the questions. So let's start with those, and we will see what other questions come in. And I do have a few others that would have come from the community otherwise. So the first one from Michael is, how much of Ultra's loan book makes up Dolla's loan book?
I think the group loan portfolio, 33% or about a third of that. If I'm correct me if I'm wrong, Trevine, but I believe a third, 34% maybe to be precise, is the contribution from Ultra in terms of the loan portfolio itself.
All right, thank you for that. I feel like you get that question every earnings call. Well, I think we need to make it a standard part of the presentation at this point.
Yes, yes.
And the next question is, that he's not seeing the Evolve loan book, but I think you would have explained this one, why they wouldn't be seeing anything about Evolve just yet in the Q2 report. And the next part of that question is, why is it that the interest income seems flat at 4%? I think that's the net interest income.
No, so I believe that would be the interest income. Well, there was a. It's not flat. It's relatively flat.
Relatively.
So there was a 4% growth in interest income, and obviously, again, Trevine would have spoken about the fact that we would have seen some slowdown in disbursement from the latter part of 2025, obviously from the hurricane, and that would have run over into 2026, where quite a number of our branches would have been impacted. So we'd have seen substantial reduction in sales, and that obviously will contribute to a decline in the income. So while the loan portfolio would have grown, um, for what am I saying now? So the interest income and how it's calculated on the reducing balance, you find that when we book new loans, you earn most of the income at the beginning of the loan.
Mhm.
So if you have a
Mhm.
loan portfolio, even though there's a growth in the portfolio, you're actually booking less income as the loan portfolio matures. And what you will find is that you have quite a number of loans that are reaching their matured state, and if you're
Mhm.
not disbursing funds at the same rate that we used to, then you will definitely see a fall off in the interest income. But the good thing is that, as I've said, we have really seen an uptick in terms of disbursement. A lot of things are returning to normal, and
Mhm.
we should see some improvement in this metric in Q3 in the Q3 results.
All right, thank you for that. Turbine, I see you nodding in agreement. So I feel like you covered it. Is there anything else you wanted to add to that
No, he
response?
covered it perfectly fine. I was on mute, but Kenroy is our accountant also, has two hats.
I get you. All right. So Michael is also asking if you're looking to go back to the bond market, seeing that there is now an uptick in sales.
So we would have closed a bond in January of 2026, which was 6 months ago. We're not looking to go back immediately, but should there be a need, we have our partners, Mayberry, who are ready and willing to assist us. So I wouldn't say in the next 3 to 6 months, but next year is a whole different ball game.
All righty. Thank you for that. Now we have a few questions from Philip. And Philip, well, this was a statement before, and I think Kenroy, you had stated this in your talk earlier, that the Evolve deal would have been signed off by the BOJ on June 30th, but the transition is still in progress. And you had mentioned in your outlook that that is a focus for the next few months. So we can move to the next question, or the next one from Philip, which is asking what accounted for the higher income tax payment in Q2 versus Q1.
So, Philip, that one is actually an accrual. We would have closed out our group numbers in terms of the audit, and then we would have moved on to perfecting Ultra. And between those two times, we would have had to go back to our tax guys to say, hey, we have some adjustments. They did make some adjustments, which would have resulted in a higher accrual for taxes on the Ultra side. So it's just a matter of timing, in terms of it should have been accrued in 2025. It happened in 2026. So
Okay. All right, thank you for that. And his next question is, how long do you expect it to take for the bond funds to be dispersed?
So
Um, go ahead, Trevin.
so that one we would have discussed in the presentation. We have our summer promotion going on, so we're expecting it to be fully disbursed within the next 1 to 2 months.
All right. So one of the things that you had raised and in the discussion earlier was about the hurricane and how that would have impacted operations, etc. And I just wanted to remind the audience that in the last earnings call, we did have a conversation about that, and the dollar team would have shared that they were making arrangements available or making it possible for persons to come in and make arrangements should it be that they were having trouble repaying their loans. How has that been? Has there been an uptake for that offer? And how is that impacting your NPL at this time?
All right, thanks for that, Renee. So the we had some moratoriums. I mean moratoriums in terms of interest only payments for a certain period of time, or where the impact would have been devastating for the customer. Would have had like 3 months moratorium for some customers. Obviously, we have stopped offering that moratorium as at April,
Mhm.
but the take up was, I would say, maybe about 50%, somewhere there about, for clients in the region that would have been impacted by the hurricane. The good thing is that, for the most part, we are seeing where things have been improving, both in terms of repayments. So
Mhm.
we're tracking the monthly repayments from these areas, and we have seen an improvement. And it also, the other signal that shows that there is also significant improvement in, for those clients as well, is that we have been seeing a significant uptick in terms of loan demands and applications, and persons actually being in a state now where they are ready to build back their businesses. And we've seen just real growth throughout the branch network, throughout the branch network in those areas in terms of loan sales, especially since June, July, and the momentum has been spilling over into August. So I would say that based on the information that we have, there seems to be some significant improvement. We're not 100% there,
Mhm.
obviously, and we still have some accounts that are being impacted. I wouldn't say a significant number of those loans, but there are still some loans in the NPL that are still coming from persons impacted by the hurricane, who are just not in a position to, even though we have offered them moratoriums, we've reduced their payments, they're still having a little bit of pressure in terms of cost and making their payments. So
Mhm.
we have been trying to work with those customers, and the big picture is that we're seeing improvement, and I
Mhm.
believe that's a good signal for the business.
All right, thank you for that, and thank you to Dollar for having that approach, because the recovery is not going to be a short one.
Yes,
Having been spending some time down in the West myself, I've seen it, and it will take time for people to recover, and they are our people, like we are all Jamaicans, right? So
certainly,
I
certainly,
really do appreciate that grace that is being extended, and I do hope that the recovery will be aided by the approach that Dollar is taking, and I love to hear that people are rebuilding their businesses.
certainly.
All right. Yeah. All right. So Michael says Dollar is becoming a regular dividend payer, and he loves he loves that. Is there anything that you want to say about the dividend payments? Because we know, again, that is always a topic of interest for persons, and persons would have been asking, shareholders would have been asking about dividends for a long time. So the fact that you have been paying out is a good thing, and it's a big deal. Is there anything else that you'd like to say on that?
So I was leaving this on the Trevine, who manages the finances, but I would just say that our dividend policy still continues to target a distribution of 50% of profitability. And the biggest thing is that this is really subject to the liquidity of the company, the expenses that we have. I mean, Trevin mentioned interest expense, um, interest expense being on a quarterly basis somewhere to the tune of about $100 million. So it all depends on the liquidity of the company. It depends on the growth opportunities, because where the company has cash and it sees that we see that we can deploy these sums in a month or two, then obviously it would make more sense for the company to reinvest the cash rather than paying dividend. Grow the profit, and maybe we'll be in a position to pay a bigger dividend at a later time, throughout the year or early next year. So that still remains a policy. It's really contingent on the liquidity and the cash, the needs that the company have in terms of the obligations that we need to meet. And I believe that has really been the policy that we've taken over the last several years, and it still continues to guide how we determine dividend payments and how the board adjudicates on this matter.
Yeah.
I love that you went straight to the policy. because because I think sometimes shareholders forget that there is a policy that guides these things, and it's not just how you feel, but
Yes.
Yes.
it is what has been signed off on and agreed, and this is
Yes.
what is guiding the company and the decision. So thank you for that. DK Ron is asking if you can explain what happened for the cash flow statement. The line loan received shows 1.12 billion for the 6 month period ending Q2 2026, but showed 1.5 billion for Q1 2026.
Yes. Okay. So, perfect explanation for this. We would have closed the bond, $1.5 billion bond, but we would have made adjustments in Q2 for all the expenses that were deducted from the bond proceeds. So, for example, our broker is Mayberry. We would have had a loan with Mayberry, as you would have seen on the December 2025 financials. That was deducted, and that was to the tune of about, I believe, $350 million. All the bond expenses, etc., were deducted, and the net of that would have been about $1.1 billion. So we ended up making those adjustments in our Q2 financials once the reconciliation was done and everything was closed off.
All right. Thank you for that, Travine. Philip is asking, and this was actually a question that I had for you as well. So I'm glad Philip is asking it. Will Dollar be utilizing technological tools like AI to assist with the loan underwriting, given the acquisition of the Evolve loan portfolio? And we really have been talking about AI implementation for a little while. So, what's the update on that, Ken Roy?
It's a tough one, I've addressed this question. The acquisition of the Evolve loan portfolio comes with two. There are some aspects of the portfolio, and I can say that for some adjudication, we are maybe closer to using AI for adjudication, especially when it comes to the retailers. Those are the businesses who sells games for Supreme Ventures. So there is an AI tool that they currently use, and that is something that we are studying currently to see if it's an approach that we also want to take with those clients. I've said in on previous earnings call, though, that the conversation about AI is very important for the business. I think that we ought to be looking at practical ways to improve efficiency. However, it because the bulk of the loans that Dollar processes are business loans, we kind of have a lot of unique elements when it comes to our loan applications. It's not like we have a standard product like a small personal loan where you have a job letter, pay slip, IDTR, and those, and we have that information where you can just put it in a system, and it just spits out the result that you want it to. It's a situation where it's difficult to find a technology that can interpret different business rules for different customers and give you a result. So that's a problem that we're faced with. So while we have made some progress in terms of identifying suitable systems that can assist in terms of speed, it still represents the smaller portion of the portfolio, which is not necessarily our um, the strategic target base that we have per se. And I believe that is where we have a little bit of hold up, because when you look at the cost versus the benefit, for that the cost that you'd have to input for 5% of the portfolio and to get the technology working for this 5%, that's where we are kind of assessing. But I must say though that in relation to the Evolve portfolio itself, there is a tool, that an AI tool that is used for their retailers, and that is actually one of the in their customer base that we have acquired. That is one of the areas that we're looking to serve, and I believe that that tool is just a matter of actually understanding it and ensuring that it's actually fit for what Dollar wants, and then we can decide if that's something we will implement. Yeah, I know that was a long answer, but it's always a very it's because people view AI as something that you can just install and it spits out results. But if you have to kind of understand the business rules, the nature of the clients that you're dealing with, the types of application, and the uniqueness of each application, and whether there's an AI that can actually adjudicate on all of those applications, and give you the result that you need for each application.
Right, right. Thank you for the explanation, Kenroy, and the update. We appreciate that. The next question is, if can we get a preview of the impact of the Evolve loan book acquisition in terms of size, and if the return on the Evolve loan book is similar to dollars?
So regarding the impact, no, the Evolve loan portfolio was a little below 400 million when the deal closed. So we will see that impact in terms of the loan portfolio, but correspondingly, we're financing the transaction. Hence, you will also see where there is an increase, a corresponding increase in terms of borrowings or debt. So at this point in time, the impact is nil. The whole aim of the Evolve transaction, and I believe Kenroy mentioned it, is to leverage the customer base of that portfolio to ensure that we are able to extract all the value out of it. And that is the real true goal at this point in time. I don't know if Kenroy, if you have anything you'd like to supplement.
Perfectly said.
All right. And the last question I'm seeing for now is from Michael. Are there any more acquisitions on the horizon?
I mean, we continue to the fact is that there are always opportunities, I believe, for acquisition. There are I look at some financials that are available, and we do kind of see where there might be opportunities here and there. But at this point in time, I think the focus is really on closing the one that we do have, ensuring that its integration, it integrates well in the business that we are doing. And maybe from the Evolve acquisition, we will have a better appreciation of how to go about doing the second one. There are opportunities, but it's not something that we are actively looking for at the moment. If there is an opportunity, we will explore it and make a decision from there.
All right. Thank you for that. Philip is agreeing with you that the customer base from Evolve is a treasure trove of data, and it's perfect for a good, emphasizing the good AI application to be applied over. And I was going to say, Philip, I feel like you're a tech guy,
No,
so I was
Philip, I
wondering
know. Philip
if you
certainly
were
is a tech
making a
guy.
recommendation. you know,
Philip,
could have,
I think we started having some conversations. I know for sure that
yeah. Yeah, because I know Philip as a tech guy as
yes.
well. So I was like, you can make the recommendation. It's cool. And Lenworth is asking, how was the Evolve loan book acquisition financed?
So this was just financed by quarterly payments over time to evolve over a 1 year period. I believe we have a payment of 30/70 based on my recollection of the transactions. It's very simple, very simple.
Okay. All right. Thank you. And I think that's the last question that we have at this time. And Philip is again showing his support for the Dollar team. So Again, congratulations on a great quarter. If there are any other questions from the audience, please do put those below the video, and we will be sure to share that with the Dollar team for their responses. As it is right now, we are at the end of our session, and we just want to thank you, our audience, for being here and for participating. It's always good to see and hear shareholders participating and engaging with the companies that they're investing in, because at the end of the day, it is your money too. It is your company too. So it's important that you know what's going on with them. And thank you to the Dollar team for being here. And as I said at the beginning, it is truly a blessing to know that you care and to know that you have committed to being here every quarter and sharing just the details, not just numbers on a sheet each quarter, but you are here. We're seeing your faces, we're hearing your voices, and you are giving true value in the content that you're sharing with us here every quarter. So thank you, Kenroy and Traveen. We are missing David today, but we appreciate the entire team. And with that, I will give the floor to Kenroy, as usual, to have his closing remarks for the audience.
Okay, so thanks again, Renee. And I mean, thank you once more to our viewers. I mean, our first half, the results for the first half of the year are really encouraging, and it really demonstrate the resilience of the business. We enter the second half with strong liquidity. That's a good thing. And as I've said, we've started to deploy those funds, and in a very prudent way. We've entered the second half also with improved credit quality and just clear opportunities for continued growth. So really, I just want to thank the team at Dolla Financial Services. I mean, everybody plays their own role. Everybody plays a part in terms of the results that we deliver. From the admin assistants who greet the customer when they come through the door to the executives, Trevine McKenzie, who prepares the financial. Everybody plays a part, and I really want to thank the team for the hard work, the resilience that they've demonstrated for this period. Thank you very much for your continued support, shareholders, and your trust in the company. And obviously, as I said, the second half of the year is one that we can anticipate even better results than what we saw in the first half. And I look forward to being here to discuss those results with you as we release them or as the time goes by. All right, thanks again, and have a wonderful evening.